Ashmeet, Sidana. I run Engineering Capital, which is a venture firm that focuses on investing at the seed stage in IT infrastructure. I'm typically the first investor. I'm happy to lead a seed round, unlike most angels that you may meet. And the tagline for my firm is Venture Capital for Engineers. So we are not afraid of hard technology. If you're solving a hard technical problem, come and see me and I'll be happy to write you your first check.
I'm Jay Kidd at Wing Venture Capital, and at Wing we focus on early stage investments in enterprise tech, basically investing in businesses that sell to businesses. It's a young firm, but with some really seasoned experience within the firm. The two founding partners came from Excel and Sequoia, and between them have done initial investments in 17 companies that became billion-dollar valuations. And we have a number of people in the firm as well who are CTOs, CMOs, senior executives in established companies. And our focus is on hands-on, helping enterprise tech companies get through the early stage problems and grow on to become companies that matter.
I'm Jocelyn Goldfein, and I am the newest of 3 partners at Zetta Venture Partners, which, like my co-panelists, is an institutional seed stage firm. Zetta is also focused exclusively on startups that are solving business problems for other businesses. And in particular, we are looking for startups whose products, where the core value proposition comes from data or AI. And we find that these businesses are unique. You have unique needs. There's a bootstrap challenge to acquire enough data to create enough value to get that flywheel spinning. But once it's spinning, there is an incredible competitive advantage. Our firm has invested in companies like Domo and Inside Sales and many other more early stage companies. And we too like to roll up our sleeves, like to lead rounds, and like to really help you build the company.
And then finally, I'm John Dalfonsi. I'm a managing director at a firm called Roth Capital Partners. We're an investment bank that works with emerging growth companies, either in private raises or going public. As a matter of fact, the reason I'm here is there was a company that was part of the TiEcon 50 last year that we took public in December called Sinestec. So we sponsored the conference, and I'm back. So in order to gauge the questions, I kind of have a survey for the audience, and if you could just show me a raise of hands if you fall in this category. Which of you, if you could raise your hand if you're an entrepreneur interested in finding out how you could possibly raise money for your company, raise your hand. Let's see, okay, it's about 10-15%. Okay, how many of you are venture capital or individual investor, just kind of trying to figure out, okay, that's one, okay. How many of you are a CEO or top management or upper echelon management of a company with 10 million in revenue or more? Okay. How many of you are in business development, an acquire, okay. And then finally, how many are here just for educational, just to learn about this segment? Okay. So it looks like most of the people here are entrepreneurs looking potentially for capital, and then second are people who are looking for education. So I want our panel, all our senior individuals at venture capital funds, let's first talk about what kind of hot areas or areas of interest or emerging areas within this space that are catching your eye right now. And why don't we start, with you and then come all the way towards me. So, Ashmeet.
Sure, John. So I think there's a massive transformation taking place at the infrastructure layer. And the easiest way to visualize this transformation is to imagine that you were to walk into one of the best data centers in the world today, which would be run by a company like Google or a company like Facebook, or perhaps even an Alibaba in China. And what will you find in this data center? You will find that they did not buy anything from HP, IBM, Dell, Cisco, EMC, NetApp, Juniper, Microsoft, Oracle, VMware. I can go on and on listing the who's who of the IT sector, and none of them are providing or powering any of these modern data centers that are so powerful, so efficient, and can enable so much technology. And so this gap is what is really creating this transformation in software infrastructure. And will there be hardware companies created? Yes. Software companies? Yes. But the entire ecosystem will change. And so that's why I see so much opportunity in software infrastructure.
You know, there's a couple of things that make a trend hot. And above all things, you're following a secular trend of behavior of the customers. We've seen a number of the earlier sessions here in this track, but the movement to the cloud is the secular trend that end users are putting applications there. So anybody who comes to us with a business model which assumes an on-premise deployment of software or hardware, it's kind of a non-starter because basically that's not what is growing. It is in secular decline at this point. So you want to be in the cloud, that's hot. There's also some false positives around developers, because a lot of things in containers and microservices and tools for developers sound really sexy. There's a lot of people who want to build products for that, but basically nobody spends that much money on developers. Really where the money comes in is when the developers have created portable applications, easy to be deployed in the cloud, and they have to be operated in production, monitored, managed, secured, tied together on networks. That's really where the money is. That layer of software infrastructure that will run in the cloud and reach back onto the premise to create this multi-cloud environment, but be cloud first. That's really what's hot.
Well, I certainly agree with what Ashmeet and Jay had to say, but I'll try to say something additional to what they've already added, which is, you know, if cloud is the secular trend that has already transformed infrastructure, the next one coming is artificial intelligence. And we're kind of at peak hype cycle on AI right now, but I believe that like cloud, like mobile, like the internet itself, that hype is justified. That AI is really going to transform all the technology we build and all the ways that we build it. And so I am excited about that creates tremendous new opportunities for infrastructure companies, both because we will need a new infrastructure to power the artificial intelligence. It's incredibly storage intensive, it's incredibly compute intensive. We need to invent new models for dealing with these kinds of workloads. Moreover, I think the AI itself is going to enable us to manage our infrastructure differently. And that is an area that I could not be more excited about. In terms of managing our storage, managing our compute, managing our networking, managing our applications, managing those clouds and containers in production. So that's I'll add that trend to the hopper.
And I would be remiss if when we're talking about sectors, I was to not bring up security as an enormously important trend right now, because it is a problem that pervades all aspects of our society. We've seen this, it started as just this narrow thing of people having an antivirus, on their desktop, but it's really an entire industry now, and as we've seen from recent events, it can have significant impact in areas that we never imagined before. So I certainly see a lot of investment going into security. There are many unsolved problems in security, and this is, again, a secular trend, orthogonal to the movement to the cloud that I see continuing.
And Jocelyn mentioned in her introduction that they focus on data companies that generate data. We have a sort of a similar belief at Wing, and every business there's basically an exhaust. There's data exhaust. The operations generates data, business process generate data. Running things at scale in IT environments generates data. That's the fuel for AI. So if you're looking at how to solve a problem in the large with greater levels of automation, figure out the stream of data that comes off the existing processes, how you can apply machine learning and artificial intelligence to it to automate running things at larger scale. Because ultimately what customers want to do when they go to the cloud is not have to manage the details. They just want to manage the policies.
So you have a sense of what our panel's looking for. Now, sitting there as an entrepreneur or someone who might be an entrepreneur one day, I'm sure we all know that they get plenty of business plans. And I guess I want to start with you, Ashmeet, and then head towards me. Your business is your business, but what things can an entrepreneur do competing against the rest of the business plans, what things can they do to kind of catch your eye? What kind of intangibles or what are kind of the lesser known facts of how do I get a venture capitalist to review my business plan, to take a meeting, to show interest in me? My plan's my plan, but are there other things that you look for that cause you to decide to look at this one versus all the others in the pack?
So I already mentioned one of them, which is if you're solving an interesting technical problem, and here's how I define what an interesting technical problem is. If I was to describe what you are doing to a competent engineer, they would not know how you are doing it. That is the bar for solving an interesting technical problem. I shouldn't be able to walk into Google or Facebook, grab an average engineer, and he would say, oh yeah, I know how they would be doing that. If you can pass that test, that is definitely interesting to me and to engineering capital as an interesting technical problem. That is a necessary but not sufficient condition for investment. So to be sufficient, there are many other things that have to be present. It has to be a team that is motivated, that is complementary to the problem you're solving. The market has to be big enough. It has to be capital efficient to work from a venture model perspective. So these are all the elements that you look for in a classical venture model. But in particular, I look for things which have that technical angle to it. And then the last thing which I would say is if you want to catch my eye, I do get a lot of inbounds. Every venture capitalist gets a lot of inbounds coming in. And so try to get a referral. Get an introduction through someone who I know. I have 6,000 connections on LinkedIn. There's no shortage of people who know me. And you should be able to find a path to get a nice introduction, and then I'm happy to meet with you.
Thanks. Yeah, I agree with that and everything Ashmeet said on there. The one thing I would also add is in addition to understanding, having defensible IP, I love that description of you can describe the how but not the what but not the how. You also need to really understand who your customers are, what they care about, what motivates them, what drives them to buy, and who your competitors would be, and how you will stack up against them. Ultimately, you have to differentiate. You're going to be later to market than people who are already out there, so you have to differentiate in some meaningful way. The two other things that we often don't see in teams that come in: commercial instinct. We're not interested in investing in a company that's there to pursue a mission or to create an interesting piece of technology. We're interested in a company that sees a path to actually making money and creating value. And if the CEO doesn't have that instinct about how is this going to generate value, that's a red flag for us. The second thing is the makeup of the team. I believe that there's three key attributes that have to be present in the founding team. It doesn't have to be three people necessarily. There has to be somebody with the technical intellectual property, the technical idea, understands how to build something unique and differentiated. Has to be somebody with the business sense, to understand how to commercialize it, understand the customers, figure out minimum viable product featuring, things like that. Then there has to be, frankly, the adult in the room who knows how to operate a business, figure out budgets, figure out priorities, management, and those skills are the formula that's a recipe for success in a starting team.
All right, it's really tough being in third place.
Go first next time.
Gonna make me first next time, because these guys have covered 90% of the important stuff. But if I can think of a few postscripts to put on that, it's actually really useful to do your homework on the VC before you ask for the meeting, and certainly before you take it, because last but not least, showing that you understand what the VC cares about and what they want to do is a pretty good way to make sure that there is also, we talk about product market fit, we talk about founder market fit, there's also, startup VC fit. So making sure that fit is there and you demonstrate that. I'll also say, just to sort of put a bow on all the elements that you've been given, market, product, competitive advantage, team, the most important one of these is actually market. And, I walked into this space really thinking it was people. That was my experience in my whole life operating, 7 years at VMware, 4 years at Facebook, was that the people were the core thing. In startups, what we look for all those things, but above all, market. And that's because it's the one thing that's really out of our control and it's out of the founder's control. If the people, are great but incomplete, maybe you've got that fabulous technical team that lacks the commercial instinct, maybe we can hook you up with somebody else who adds that who brings that to the table. If there's a founder drama, worst case, maybe we can part ways with one founder, the startup will go on. If the product's not right or the technology's not right, well, that's at least in-house, we can try to fix it. We can't change a market. That's out of our control. And Warren Buffett's big conference is going on right now, but one of his many famous quotes is, when a business with a bad reputation meets a management team with a good reputation, it is usually the reputation of the business that survives.
And so I'm going to ask one more question for the panel, and then I'll leave about 10 minutes for questions. So you found out what this panel's interested in, and you've heard how you get noticed. So now you're in the door. You're talking to one or two venture capital firms. And Jocelyn, I want to start with you. What is the biggest cardinal mistake? What is the biggest mistake you see entrepreneurs make when they're in the process, getting money, and then a mistake that they make, once they have the money? So if you could touch on both.
Oh, entrepreneurs are snowflakes. They make all kinds of different mistakes. I think a big mistake is to spend the money too fast, is to view the fundraising itself as the prize, as the destination, as the accomplishment. And now that I've got the money, that means because I'm entitled to spend it. Not at all. Fundraising is a means to an end of building a business, and you should spend it as fast and no faster as your business deserves it. Of course you have to invest. Of course you've got to hire. But raising a $2 million seed round is not the time to go on a hiring spree or to gold plate your office. It's a time to sort of, miserly, stingily part with every penny, because that gives you a really short runway to increase the value of your business such that you can raise the next round. And so sort of letting that sense of success at fundraising go to your head doesn't mean a thing. Go ahead and spend money when you have revenue coming in the door.
Yeah, I agree with Jocelyn. There's so many mistakes you see. By far the worst is arrogance. If you believe that you are doing the investor a favor by being there to let them look at your company, that's not a good thing to do. You want to understand your customers. If we see somebody who doesn't understand their customers and it can't really articulate the value they're going to deliver, that's a big red flag for us. And I really agree also with the comment about spending the money too fast. There's a phrase we use, which one of the worst things you can do to a company is give them too much money, because that allows them to prematurely commit to a strategy before they have to validate it with a few customers and get something in the market and get feedback. And we've seen companies that have great ideas just fail because they spent too long polishing it and ran out, basically built up too big an infrastructure and ran out of money.
Like Jocelyn and Jay observed, there are many different mistakes you can make, and fundraising is a complex, arduous, different process. And so let me focus on one aspect of fundraising and make an observation which may help the entrepreneurs in the room. A common misconception of entrepreneurs. So firstly, when you go out to raise money, you're often going to get no. By definition, you'll get many more no's than you get yeses. If you're in the fortunate position of having many more yeses, that is unique. Please give me a call immediately. My cell phone, don't worry what time it is. I want to talk to you. But here's the serious side of it. You're many times going to get no, and entrepreneurs will often take the no more seriously than it actually is, especially early in the process. The no is not always a reflection on the quality of your company, presentation, team, idea, or even market. Many times it is simply a reflection of a match not occurring. In other words, the firm is at a different stage, different focus, different interest, etc. I literally know hundreds, perhaps even 1,000 venture capitalists, and each one of them has a different focus and a different thing that they're looking for. And so you should be aware that while you can learn a lot from a VC, while it is definitely not good to be arrogant, and there's a lot of learning that isn't there available to you in the fundraising process, when you get the no, don't overthink why you got the no. Try and understand why it may not have been just a good match for you.
And I want to add one 30-second thing, then we'll go to questions. The number one mistake I see is valuation expectations. I can't tell you how many entrepreneurs I see who say, my company's worth X, because they have one data point of Cisco paid this or whoever paid that. And my advice is focus on the money, because the venture to be a venture capital fund is a very high bar. And the people running these funds have a very good sense of the market, have a very good sense of, have a very high integrity. And whatever term sheet they're going to give you is not going to be far off from market. Maybe there's a little bit of room to negotiate, but focus on the money. Don't worry about the valuation, because at the end of the day, whether the investment is accretive or dilutive is up to you as the entrepreneur. If you get 10 million and you turn it into 500 million, that's accretive. If you take 10 million and you make it a zero, that's dilutive. So don't worry about the number they give you. Focus on what you can do with that money to make everyone money, including yourself. I've seen so many deals break up because of the entrepreneur's misconception of their valuation. So with that, I'm going to have Raman, he has the app, I'm going to have him take questions.
No, there's one question already from the audience, which you can take 5 hours answering. So the question is, hasn't AWS commoditized the IFA infrastructure? So where is the innovation left to do?
So has AWS commoditized infrastructure? I think AWS has established what people believe to be a more efficient way to run infrastructure. So in that regard, yes. There's always opportunities to run sort of a layer of software on top of what AWS has commoditized. Because they've commoditized server, storage, networking, some of the basic database functions. They haven't commoditized orchestration. They haven't commoditized application. They haven't commoditized security. There's a whole lot of other value add on top of that. But the model of running things at scale with sort of, infrastructure as code, I think we're never going back from that. And the hyperscaler cloud providers are the ones who've defined it. And that model will have to find its way into the enterprise for enterprise on-premise IT to survive.
I'll give you a dollars and cents answer to that question. The companies that I named when we started this panel, the companies that are the number 1 and number 2 in the IT sector, collectively represent about $1 trillion a year of revenues. This is not market cap, this is not cash on their balance sheet, this is actual customers writing checks to them every year today. Amazon is making $12 billion on AWS. That's a lot of money. They've grown very rapidly, and I fully expect that $12 billion to continue to grow very, very quickly. But 99% of the market has not been touched yet. This is a massive transition. It's a secular trend. And there's lots of opportunity in the kinds of areas that Jay has observed. What Amazon has done is raise the bar on competition because they have a very innovative business model. They've reinvented how we think about infrastructure. And so you as entrepreneurs have to think creatively on what you will do that will prevent Amazon from eating your lunch. You absolutely have to answer that question if you're going to build a successful startup.
I'll just give you a punchline. Have you seen the cartoon with 2 cavemen, and one is looking kind of really slumped and dejected, and he says to the other one, fire's been invented, the wheel's been invented, I think that's it, there's nothing left to invent.
But there's one thing I'll add on, building on Ashmeet's comment, is several of the companies have been up on panels before, were invested in 4 or 5 years ago, they're doing on-premise infrastructure. There's an opportunity in that where the 99% of that $1 trillion was going to do refreshes of that. And that'll last a little while. But the fact is that the on-premise infrastructure is no longer growing. And so everything that you build to go into that present is a replacement market, which is always a tougher market than in a segment which is growing. So as an entrepreneur, it's easier to go after the cloud environment where there is growth, there's a bit more of a landscape to move into. Than trying to focus on competing with what's going to be increasingly hungry and more ferocious traditional vendors. I worked at one of them for a while.
Okay, I'm curious as to what the panel thinks. I've been doing this for 40 years, and with John, you were a great sponsor at the American Electronics Association. If you remember, for 25 years they had it in Monterey. They moved it to San Diego for about 3 years, and then it petered out. The last year, there were only 51 people and 36 companies, down from 1,000. It seems like right now we lost the sauce. It used to be Hambrecht and Quist, Robertson Stevens, Alex Brown. They bring these companies public, everyone would make money. Right now, either you have revenue, you have revenue but not earnings. I think we're in the third year of the Valley of Death, which is going to continue until 2019, where all these companies that are raising a lot of money, it's going to be like Amazon, goes from 100 to 6, and right now you save your money, they go public, they're going to go down 50, 60, 70%. 2 years from now, then you buy it, because we're not delivering revenue and earnings, and that's what's missing.
Were you asking about why aren't many companies going public? Is that why?
No, I'm just asking this environment, where I think we're in a very strange environment where there are like 60 SaaS companies, and most of them are losing 10, 20, 30, 40 million dollars a year, and they don't have anywhere near profitability. When you had a company like Adobe. I'm the only one who has been invested in an Adobe. I've owned it for 31 years. It's gone from 5 million to 5 billion. There used to be a lot of companies like that. There aren't anymore.
I see. So you're saying there's so many companies in a particular category, are they all going to make it, or is that?
Okay.
Yeah, so it's a very good point. So let me give you some statistics. The public markets were the primary way for an emerging growth company to raise money in the 90s. There was 500 to 600 IPOs per year in the 90s. I worked on about 22 IPOs in 96, and when firms like Montgomery, Hambrecht and Quist, Robertson Stevens, Alex Brown, they were all around. So fast forward, the dot-com bust happens, Elliott Spitzer, Enron, and we go from 600 IPOs per year to less than 100. 10,000 public companies on NASDAQ and New York Stock Exchange and Amex in 2000 to only 3,400 today. And about 3,000 of those have been bought. The rest have gone out of business. Meanwhile, the number of US-based venture and private equity portfolio companies is 19,100. So the question is, we're seeing a reemergence in the IPO, but there isn't the IPO market, given the current players, can only probably take 250 to 300 IPOs per year. And if you dissect that, that's all sectors. So say 20% are tech, that's pretty high concentration, that's 50 IPOs. So you're right, you're gonna have a lot of companies, there's only maybe 50 tech IPOs per year, there's venture funding, and they're gonna become more selective. It's a good question, what's gonna happen to all these companies that have been funded? Yeah.
I think this is a structural problem. I think we have created a structural problem for ourselves. We had the best public markets. We have deep, liquid, large amounts of pools of capital, but this is really a problem that Washington and New York have to fix for us. And long term, it's not good for our industry, it's not good for us. So please call your congressman or call your favorite lobbyist or however you want to work on this. But we need to solve this problem. We have gone way too far on the side of regulation and control, which is not healthy for innovation and eventually for us as entrepreneurs and investors.
Was it ICOs is the latest trend now? People are going public on the Bitcoin market or Ethereum. So, but if good companies will find capital.
Well, anyway, thank you for listening. Thank you for the questions, and let's give it a big round of applause for our panel. Great.